Hello, awesome mindsetters. It is that time again. It is winter school, and my name is Abraham, joining you in this awesome and wonderful day. Hope you're up and ready to learn more and learn extra with us. Yes, of course, on this show, I'm not alone. I'm with Mahesh. Mahesh, how are you?
I'm well, Abraham. How are you doing?
I'm so revived and ready to learn more.
Good.
Especially now that it is accounting, and accounting is one of my favorite subjects.
I know
You know
that.
by now.
Yes, I do.
All right. Can you take us through what are we doing today?
Okay, guys, today we're going to be focusing on the cash flow statement. We're going to be doing a bit of revision on the cash flow statement. And I'm sure you already know, together with the cash flow statement, you always have some ratio analysis. In other words, analysis of the cash flow statement or financial statements. That's what we're going to be doing today.
Awesome. I like that. You know what mindset is we're about to learn also. We also have a cool competition that we'd like you to enter for. The competition today, it's simple. You know it. If you've been watching the shows throughout, you can stand a chance of winning this awesome DJ Whiskey CD, proudly sponsored by Soul Candy. All you need to do is go over the link that I'm going to send you to enter for the competition. The rules are simple. We're giving you a stat on our Facebook page on what are the numbers that we're having, the current likes that we have. All you need to do is to try and guess the last digit when we stop the clock. We're going to start the clock now. As soon as we start the clock, you're going to jump over to mindset.co.za/learn/stop the clock and give us the number. Fill in that entry form and give us your number that you think by the end of the show will be sitting at on the last digits of our likes. So it's quite simple, hey Mesh. You're going to guess if, like for instance, now I'm going to be telling you where we're standing, and then we're going to start our clock. Are you ready for this one?
Okay.
Right. Currently, mindsetters, if you go to our Facebook page is facebook.com/learn extra. Like the page, get your friends to like the page, and let's all be Team Mindset. And now, yes, Mesh is showing us our starting point. Can you tell us the numbers, Mesh?
It's 45,457.
Right, and now we're only looking at the last digit, which is 7. So as we are starting the clock, go over to mindset.co.za/learn/stop the clock, and then guess which number by the end of the show when we stop the clock will be the last digit. That's how simple it is, and let's learn more, Mahesh.
Okay, brilliant. Right, guys, like I already mentioned, we are focusing on the cash flow statement, and today we are looking at a question that was taken from the March 2012 exam paper. Now remember, guys, cash flows, ratio analysis, financial statements counts close to 60% of that final exam paper. So please make sure, guys, you use this time, you go through the question with me, and you obviously pay attention, and I assist you in revising these important concepts, these important calculations. So let's get started. Right, let's go through the information first. This question, guys, like I already said, it was taken from the March or Feb 2012 exam paper, and if you want to know which question it was question 4. It is a question on financial statements of a company. You are provided with information relating to Ambrosio Limited for the year ended 31st December 2011. So that's our year end. This is obviously our current financial year that is given to us. Then the information that we have, before we look at the actual questions, let's go through the information first. We've got firstly an extract. Extract, remember guys, is not the entire document, but it's obviously certain bits of information. So your extract from the income statement for the year ended 31st December 2011. So let's quickly look at this extract. We've got typical examples of the income statement, or items, sorry, not examples, but items appearing in the income statement. You've got sales, operating expenses, operating income, then we're given depreciation, interest expense, net profit before tax, and if we look at net profit before tax, immediately I notice a question mark, so it's not given to me, and then I've got income tax. As we scroll down, information 2 is our balance sheet, and again, This time it's not an extract. They're going to give us the entire balance sheet. So we've got the balance sheet with a lot of question marks in the actual balance sheet. So we've got all our assets, guys, equity and liability. So there's my equity. Okay, so there's our equity. And then we have our balance sheet. Sorry, not balance sheet, but our non-current liabilities. So there's our liabilities as well as our current liabilities. Right, information number 3. We are given information with regards to shares that were issued, and we are told the number of shares, ordinary shares on the 1st of January 2011. In other words, they're giving us the number of shares that were issued at the beginning of the financial year. Then they go on to tell us 390,000 ordinary shares issued on the 1st of Jan 2011. So in other words, during the financial year itself, or at the beginning of the financial year, this company issued additional shares. And then we've got our balance at the end of the year. So at the end of the year, the company has issued in total 2,700,000 ordinary shares on the 31st December 2011. Now guys, please remember, whenever they talk about shares issued, you will always be given number of shares, okay, and then we've got the actual rand value of the shares. Right, further down, we've got something on dividends. Let's just extend this page a bit. Okay, there we go. Dividends, the next bit of information. New shares were issued at the beginning of the financial year, and then they tell us the directors declared dividends as follows: an interim dividend of 33 cents. Now remember, interim dividend is always dividends declared during the financial year. And then we've got final dividend of 20 cents. This is always at the end of the financial year. And something that you guys, I'm sure you guys know this, but let's quickly recap. Interim dividend plus final dividend gives us our total ordinary share dividends. Okay, right, next bit of info, guys. We've got information number 5, which deals with tangible or fixed assets. So this business has land and buildings. Then they've got equipment at carrying value as well as vehicles at carrying value. Now, very, very important, they're giving us the current year, which is 2011. So I'm just going to remind myself that 2011 is the current year. And then we've got 2010, guys, which is the previous year. So the previous financial year, these were my fixed assets, or the value of my fixed or tangible assets. Then I've got further information with regards to tangible assets. I'm not going to read through all of this just yet, guys, but I know when I do get to the tangible assets, then I've got info that I need to read. Okay. Then information number 6, trade and other payables, includes the following. So I've got trade and other payables. In other words, it's obviously a balance sheet item, and it includes the following: my trade creditors, shareholders for dividends, and then I've got SARS income tax. And again, they're giving me 2011 as well as 2010. 2011, one more time, guys, this is my current financial year, and 2010 is my previous financial year. Okay, right, next bit of info. Coming to the end of the information, information number 7, they're giving me some financial indicators. Now remember, financial indicators, these are obviously some ratios that have been already calculated, some obviously haven't. So if I scroll down the ratios that the question is giving me, or the information is giving me rather, I've got operating expenses on sales, operating profit on sales, net profit after tax on sales. So the first 3 immediately I know is my operating efficiency ratios, or profitability ratios. Then I've got debt equity ratio, which is obviously risk, return on average shareholders' equity. So I've got a return ratio, earnings per share, dividends per share, return on capital employed. So in other words, all four given to me are my returns ratios. Return on capital employed can also be a risk ratio, guys. Then I've got solvency ratio given to me, and then finally current ratio, asset test ratio, in other words, some liquidity ratios that have been calculated as well. And then finally, guys, the last bit of information, we've got the cash flow statement. Now, they're giving me a bit of the cash flow statement. So if I look at the cash flow statement, immediately I notice it is an incomplete cash flow statement. So in other words, the question which we're going to get to now is going to want me to calculate these missing figures. Okay, right, very important, guys. Always make sure you read through your info first and then you start answering the questions. That's exactly what we've done. Right, let's now start with the questions itself. And let's go for it. Let's start with the very first question. Prepare the appropriation account. Let's get the pen out. So we're going to prepare the appropriation account on the 31st of December 2011. Now guys, at this point, I'm sure you all know how to prepare an appropriation account. You know your format, and all it means is filling in your formats and then obviously filling in the figures as we go along. So appropriation account, I know, is owner's equity. On the credit side, I'm going to record my income. On the debit side would be my expenses, and whatever profit was not appropriated has to be transferred to retained income. So let's get started. On the credit side, let's start off with firstly profit and loss. So profit and loss. Okay, I'm going to fill in my info first, or my contra accounts first, and then we'll look at the figures. Then, still on the credit side, I transfer retained income. And this, remember, is at the beginning of the year. Okay, retained income at the beginning of the year. That's as far as the credit side is concerned. Let's now look at the debit side. The debit side means, how do I appropriate this profit? Appropriate means sharing this profit. So firstly, there's going to be a chunk that's going to go to income tax. So income tax. Then the next part of the profit belongs to your shareholders in the form of ordinary share dividends. Guys, please remember, you've got to write this out in full. Ordinary share dividends. And thereafter, whatever profit remains is transferred back to retained income. Okay, so in other words, whatever profit hasn't been paid in the form of income tax or ordinary share dividends, in whatever profit is retained has to be transferred to the T account called retained income. So I've got my format, guys. Let's now go to the information and let's now try and fill in the figures. So my info, I'm going to go firstly to my income statement. Let's quickly find that income statement. Okay. There we go. So my information, or my income statement, let's just change the color of this pen quickly. Let's go for green. So I'm going to start off with profit before tax. And immediately, profit before tax, remember, that's obviously my profit and loss amount. It's a question mark. So profit before tax, I cannot fill in anything just yet. Let's now go to retained income, which would be the next item. So your retained income, I'm going to my balance sheet. There's my retained income. And remember, I'm looking at retained income firstly at the beginning of the year. Remember, guys, this was 2010, and this is obviously 2011. So beginning of the year would be the previous year, which is 2010. My retained income, 528,000. So let's transfer that onto our answer sheet. So retained income, 500, let's get the pen out, 528,000. Okay, remember guys, profit and loss, I do not know that amount just yet. So I'm just going to put a question mark. So I filled in my retained income. Let's now look at income tax. So let's go back to our information. And again, income tax, I'm sure you know this. Income tax is obviously, let's find that quickly. Income tax would be my income statement item. So there's my income tax. Okay, so there's my income tax, guys, and there's that income tax amount that I'm going to transfer to appropriation, 916,550. So 916. Let's just go back to the info. Okay, income tax is an amount of 916,550. Let's just quickly check that. It was 916,550. So I filled in my income tax amount. Next item that I need to look for is my ordinary share dividends. So my ordinary share dividends, remember I've gone through the information and I had a bit of additional info on ordinary share dividends. Let's find that quickly. Okay. Okay, there we go. Dividends, so I've been given in information number 4, dividends. I've got interim dividends of 33 cents, and then I've got final dividends of 20 cents. Now remember guys, here the ordinary share dividend is not given to me, which means I've got to do some calculation. So it's not as straightforward as income tax where I had the figure and all I had to do was take the figure and slot it into the correct place. Here I've got to calculate my ordinary share dividend. So let's just extend the page so we can do that calculation. Now, like I already mentioned, ordinary share dividends is the sum of interim. Okay, so it's interim plus final. So if I can calculate my interim dividend, if I can calculate my final dividend, all I'm doing is adding the two together to get my ordinary share dividends. So let's do that calculation. Abram, how are we doing on time? Can I finish this first and then we can go for a break?
Yes.
Okay, right. So let's start. Interim dividends of 33 cents was declared during the year. Final dividends of 20 cents. So let's start off with my interim dividends. 33 cents per share. So let's now go to your shares, and remember, you've got to take into account that new shares were issued at the beginning of the financial year. In other words, on the 1st of January, new shares were issued. So when that interim dividend was declared, normally an interim dividend is declared during the financial year, which means after the new shares were issued. So I'm looking at my ordinary share dividends after adding on the dividends, or sorry, the ordinary shares that were issued during the year. So in other words, the 2,310,000, that was what was issued at the beginning of the year, adding the additional shares that were issued on the 1st of Jan, 390,000, to give me the 2,700,000. So taking that information into account, my calculation would be as follows: 2,700,000 times 33 cents. Okay, so 0.33, and that's going to give me my interim dividends. So let's get the calculator out. So we've got 2,700,000, and just watch the zeros, guys, times 33 cents, one more 3, and that gives me 891,000. So that's my interim dividends. Let's get the pen out there. Interim dividend, 891,000. Okay, so I've got the first part of the calculation. I've got interim. Now let's look at final dividend. Final dividend of 20 cents per share. So again, I'm going to take the number of shares issued at the end of the year, which stays at 2,700,000, times, this time there's a final dividend of 20 cents per share, And again, let's get the calculator out. Let's clear that. 2,700,000 times 20 cents, and that gives us our final dividend, 540,000. So let's fill that in, 540,000. Okay, so all I've got to now do, I've got interim, guys, I've got final, I'm simply adding them together to get my total dividends. Okay, so let's get that total dividends. And where's the calculator? Okay, so plus 891,000, and that gives me 1,431,000. So let's fill that in. Okay, 1,431,000. Let's quickly double check, guys. Yeah. Okay, so remember, we did this calculation because we want to take it to that appropriation account. So back to the answer sheet, and we're now filling in ordinary share dividends, 1,431,000. Okay, right, almost done with this account, guys. All that's left now for us to do is fill in our retained income at the end of the year and then calculate the profit and loss. Okay, so let's quickly do that. Retained income at the end of the year, so back to our info. And remember, we're going up to the balance sheet. So we're looking for retained income, but it is at the end of the year. So 2011 is end of the financial year. There's our retained income, 1,195,000. So to the answer sheet, 1,195,000. Okay, and then the final part, guys, to complete this appropriation account is that profit and loss. Profit and loss is not given to me, and I know some of you are jumping in your seats because you know exactly how to calculate this profit and loss. All I've got to do is absolutely correct. Add up whatever I've got on the debit side minus whatever I've got on the credit side to give me that profit and loss amount. So let's do that. So on the debit side, I've got that figure in there already. So plus 916,550, which was the tax, then plus 1,195,000, which was my retained income, to give me the total on the debit side, which is 3,542,550. So let's just quickly fill that in. 3,500,000. Let's just go back there. 42250. Remember, that's a total that I take onto the credit side, 354,250. Okay, and then in order for me to get my profit and loss, all I'm doing is subtracting. So minus what I've got on the credit side, 528,000. And there's my profit and loss amount, the amount that wasn't given to me, 3,014,550. So let's fill that in, 3 million. Oh, just go back to that calculator, 3,014,000. Oh, 3,014,550. Let's just double check. Okay, correct. Okay, right, we've done the first part of the question. Abram, do you think we should take a break, or do you want to say something before we take a break?
Yes, just before we take that break, currently we're standing at 45,462. So 2 is leading for now. I think my number would be 6. What's your number?
8.
8. All right. Remember, Mindsetters, you have a choice between 0 and 9. And let's get all our friends liking our page, and let's see by the end of the show, will it be my 6 or Mahesh's 8 or your number? So yeah, we'll see you after the break.
Okay, cool.
welcome back to you all accounting buffins. Now I've got three things to say before Mahesh takes over. One is that you can assess yourself whether you understand or not through our Curio. Go to curio.co.za and you'll find some multiple questions there about accounting. Answer those questions and just check if you are understanding. If you still have questions, we'll make sure that we'll get over those questions through our Facebook page, which is facebook.com/learnextra. But second thing is that the competition is still on. The clock is ticking. Choose your number between 0 to 9. The entry form is on mindset.co.za/learn/stop the clock. And the last thing that I have to say is that I have an awesome quote that I need to share with you.
Okay, I'm waiting.
The awesome quote is the one that we also posted on the page in the morning. It says, you only get one chance to live, but if you live right, that once is enough.
Wow.
That's how simple it is. Once, the opportunity that you have now, live up to it.
Exactly.
It's enough.
Brilliant.
Let's continue.
Okay. Right, guys, before the break, we were busy with a question from March 2012, and now we're going to continue with that question. Right, the next question, 1.2, refer to the incomplete cash flow statement provided in information 8. Calculate only the missing figures indicated by A to E in the cash flow statement on the 31st of December 2011. The other missing figures are not required. Okay, so when we were going through the information, guys, we noticed the cash flow statement was given to us, but there was a number of question marks, and there was also a number of figures, A, B, C, and so on, up to E, that was not filled in for us. And that's what the question now wants us to do for 15 marks to complete A to E. So let's go for it. Let's go to the cash flow statement first. Okay, so there's my information number 7. We're looking for info 8. There we go. Information number 8, there's that cash flow statement. And what I'm going to do is, let's quickly highlight A to E first, and then we'll start calculating. So A is firstly dividends paid that they want me to calculate. So that's my A. Then the letter B is for purchase of fixed assets. Okay, next one, C, proceeds of the sale of fixed assets. So there's C, and then D and E are at the bottom of this cash flow statement, net change in cash equivalent. So that's D. And then E would be cash equivalent at the end of the year. So for 15 marks, all we've got to do is complete A to E. Now remember, guys, accounting and time go hand in hand. So you're going to be wasting your time if you complete the entire cash flow statement, because that is not what the question wants you to do. Only complete A to the letter E. So let's start with A. A would be dividends paid. So let's do the calculation for that. Now dividends paid, let's go to the answer sheet. Okay, now remember, guys, dividends paid, there's a number of ways in which you can calculate dividends paid. Let's start with the one that is commonly used by most of the learners, where we're going to start off with balance at the beginning of the year. Okay, so balance that you owe your shareholders at the beginning of the year. That balance, beginning of the year, you're then going to add on your ordinary share dividends for the year. In other words, that interim and final dividend that we already calculated. And then you are going to subtract your balance that was owing at the end of the year, the balance that you owed your shareholders at the end of the year. So let's start with this. Let's start off with firstly balance at the beginning of the year. So let's go back to our information, and for that we're going to go to trade and other payables. Let's just find that. There we go. Trade and other payables. So how much were we owing our shareholders at the beginning of the year? So there's my shareholders for dividends. Remember, beginning of the year is always your previous year. So I'm just going to indicate that quickly. Beginning of the year. And this current year is end of the financial year. So at the beginning of the financial year, shareholders for dividends, we were owing our shareholders an amount of 485,100. So let's take that amount through. Okay. So at the beginning of the year, 485,100. To this, we're now going to add our ordinary share dividends. Now, that's something that we already calculated and we actually use. So if we go further up on that answer sheet, let's go back there. In that appropriation account, there's that ordinary share dividends, 1,431,000. So let's take that through. Okay, 1,431,000. Okay, so two amounts already filled in, and then remember we are going to subtract balance at the end of the year. In other words, how much were you owing your shareholders at the end of the financial year? So back to our information, shareholders for dividends, end of the financial year, oopsie, let's put that back there, end of the financial year, we're owing our shareholders 540,000. So there's that amount there. So let's take that through. Okay. 500. Oh, what have I done here? Okay, let's just fix that. Okay, there we go. Okay, that amount again, it was 540,000, but I'm just going to double check that, guys. Just go back to the information. Was it? Yes, it was 540,000. Okay, right, all we've got to do now is take out our calculator and let's now calculate what is the dividends that were actually paid. So let's get the calculator out. Let's just move that onto this side here for a while. So we've got 485,100. And to that we are adding the 1,431,000. And then we're subtracting 540,000. And we're going to get the dividends that were actually paid, 1,376,100. So let's fill that in. Okay, so dividends that were paid, 1,300,000. I have to get that out again. 76,100. Okay, 76,100. Okay, not difficult, guys. Like I said, there's lots of ways to do it. This was one of the methods. A lot of students also prefer simply to take balance owed at the beginning of the year and to simply add the interim dividend, and it's going to give you the exact same amount. So remember that as well. If I want to calculate my dividends paid, another way in which I can do this is I can take my opening balance, or the balance at the beginning of the year, and all I have to do is add the interim dividends that were declared and paid during the year, and by adding these two figures, I'm still going to get that amount. Okay, right, that was A. Let's now move on to B. B, let's go back to the cash flow statement. Okay. Let's scroll down there, the cash flow statement. So B was, so we've done A. B was the purchase of fixed assets. So remember, I had additional information on fixed assets. Let's find that additional information. There we go. So your tangible or your fixed assets, there's my information. Okay, so I'm going to work on this page, and let's do the calculations as well. Remember, we're calculating now the purchase. Were there any fixed assets that were purchased during the financial year? The following changes took place in terms of tangible or your fixed assets. Vehicles were sold. Okay, so not purchased. Vehicles were sold at carrying value during the year. These have been correctly recorded. The cost price of these vehicles were 350,000, and the accumulated depreciation was 247,500 at the date of disposal. So immediately, there's no mention of purchase of new vehicles. This simply refers to the disposal, the sale of vehicles. So let's go down to the next bit of information. New equipment was purchased. Aha, so that's what we're looking for. New equipment was purchased during the year, and further down we've got land and buildings were bought during the year. So in other words, this would be my purchase of tangible assets. Okay, so let's firstly start with land and buildings that were purchased. So I'm going to start with land and buildings, and then we're going to look at the new equipment that was purchased. So my land and buildings, remember, land and buildings, there's obviously no depreciation to worry about. So as far as the calculation is concerned, 2010, my land and buildings was sitting at 4,537,500, and then 2011 it has increased to 4,950,000. So immediately, guys, I can see that there was a purchase of land and buildings, or an improvement to land and buildings. So let's get that calculator out to find out exactly what the value of this purchase was. So let's take our land and buildings, 4,950,000. Okay, minus 4,537,500. Okay, to give me land and buildings purchased, 412,500. So let's put that into our answer sheet. Okay, so land and buildings, I know it's going to be land plus equipment. Okay, so I've got land and buildings already. Let's get that, change the pen there. So land and buildings was an amount of 412. So one more time, 500. Okay, so I've got the first part of the calculation. To that, I now need to look at equipment. What was the value of the equipment that was purchased? So let's go back to our information. Equipment, guys, slightly more complicated because we can't simply subtract. The reason for that is equipment that they've given to me, it's not at cost price, but rather at carrying value. Now, carrying value means that depreciation, or accumulated depreciation rather, was taken into account, was subtracted, and then we obviously got these figures. So we can't simply subtract like we did for land and buildings. So in order for me to calculate equipment that was purchased, again, there's various ways to do this, guys. I prefer T accounts, and that's exactly what I'm going to use. So let's just extend this page a bit. Okay. Okay, so land and buildings we've done, and now we're busy with equipment. Okay, so remember, guys, this T account is simply helping me to do my calculation. Okay, so it's equipment, but not equipment at cost, but rather equipment at carrying value. So equipment, I'm just going to quickly identify my account like you guys normally do. So it's an asset. Okay, at the beginning of the year, equipment carrying value would have an opening balance. At the end of the year, equipment carrying value would have a closing balance. So let's slot in these figures first. Let's start with the opening balance at carrying value. So at the beginning of the year, my equipment had an opening balance of the carrying value of equipment, 429,000. So let's take that through. Okay, 429,000. And then, guys, at the end of the year, let's now see what that carrying value is. Abram, you're really quiet. Do you know what we mean by carrying value?
Yes.
What do we mean by carrying value?
Isn't it the value that we last have, and we still continue using the same value for another year?
Mm-hmm. carrying value is more what something is worth, the
Yes.
actual worth.
Yes.
So for example, I could buy my cell phone at, let's say, 1,000 Rand, but in a year's time, the value decreased and the actual worth of that cell phone now could be, let's say, 700 Rand.
And that is
Okay.
influenced by so many other reasons, such as
Yeah.
inflation rate also.
Yeah, and obviously depreciation.
Yes.
Yeah. Okay, so equipment carrying value at the end of the year, 495,000. So let's slot that in. At the end of the year, 495,000. Okay, guys, now remember, if you're not familiar with this account, all I'm doing is using this account to do a calculation. So it's carrying value, equipment. I've brought down the balance at the beginning of the year. I've brought down the balance at the end of the year. Now let's look at carrying value. When does carrying value go down? In other words, when does it decrease? Correct, it decreases whenever we provide depreciation. So when we provide depreciation, my carrying value is going to decrease. Have I provided for depreciation? Yes, I have. So let's go to that income statement and let's see what was the depreciation on equipment. So let's go to our income statement, which was information number 1. Okay, and there I have depreciation on equipment. That's the one that I want. And for this financial year, we wrote off depreciation of 99,000. So let's take that to that T account that we were busy with. Okay, so 99,000 was my depreciation. That obviously decreased the value of my equipment. Now, let's look at what makes carrying value increase. Okay, absolutely correct. It increases with an addition or a purchase of new equipment. So if I've purchased new equipment, my carrying value would increase. Do I know the purchase price? No, I don't. So that's the unknown to me. That's what I want to calculate. Now, once I've got this into a T account, it's now absolutely simple. I've got my known values on the credit side and obviously an unknown on the debit side, which means I can add the items on the credit side minus whatever I've got on the debit side to give me my addition or the purchase of equipment. So let's do that. Let's get the calculator out again. So on the credit side, I've got my 99,000. Okay, to that I am adding 495,000. Okay, and then I am subtracting, let's just move that so we all can see. I'm subtracting what I've got on the debit side, guys, 492. Oh, no, it's the other way around. Let's delete that. 429,000. Okay, and then the value of new equipment that was purchased is an amount of 165,000. Let's fill that in. Okay, let's use another color. Okay, so 165,000. Okay, so one more time, guys. How did I get this amount of 165,000? It was my 99,000 plus 495,000 minus 429,000 to give me my 165,000. So let's take that through to our answer sheet. So we're going to add, okay, an amount of 165,000. Let's just see if I'm taking the correct figure. Yes, I am. To give me now, okay, so I've got land and buildings, I've got equipment, and all I'm going to do is add the two amounts up to give me, so plus 412,500, and that gives me the total value of purchases that would go into that cash flow statement, 577,500. So let's fill that in. Okay, 577,500. Okay, Abram, do we have any questions?
So far, it's just comments.
Okay.
And the Mindsetters are loving the show.
Are they?
Yes.
That's brilliant.
And they're really paying attention, such as Ntogozo and Docs Hleza.
Yeah.
They've spotted a mistake somewhere, but it was not a mistake. It was one digit that was left behind.
Okay.
Yeah.
Okay.
So the Mindsetters are spot on.
Oh, that's brilliant. That is brilliant. You know what? They, I think even when they write the exams,
Yes.
because in accounting there's so many zeros and there's so many numbers, you know, you tend to make that mistake of leaving one zero out. And it's brilliant that they're picking that up. If I've done that, tell me. Okay.
Yeah, we'll surely do.
Yeah.
But in that case, don't you think we should take a quick commercial break
Okay, that's
and
fine.
get back to that?
Okay,
So that
brilliant.
they ease up a bit. And if they have questions, they can send them through on our Facebook page, which is facebook.com/learnextra. But lastly, this is your last chance, because after this break, we'll be stopping the clock. So go over to mindset.co.za/learn/stop the clock, and we can stop the clock by just checking the last digits of our likes. So see you after the break. Welcome back, accounting buffins. I hope you're up and ready and all chilled up to learn more and are sending those questions through our Facebook page, because Mahesh and I are ready to learn more and learn extra with you. And you could win these awesome prizes. We've been telling you about this winter school competition, proudly sponsored by Soul Candy. You could win this awesome. Do you listen to House, Mahesh?
I don't know.
All right,
I don't know what I
maybe
listen
if
to
your
sometimes.
number gets to be chosen, because you said 8
I did.
and I said 6, you could win maybe this DJ Whiskey CD titled The Rebirth by Soul Candy. But otherwise, before we move on, you said a powerful quote earlier on saying that accounting goes hand in hand with time. And here's an awesome quote to
Okay.
also pump you up. It says, things work out best for those who make the best. Okay. Let me read it again. Things work out best for those who make the best of how things work out. So
That's so
make the
true.
best out of everything.
Yeah, you've got to.
Let's
Got to.
continue.
Okay. Right, guys, before the ad break, we were looking at the cash flow statement, and we were obviously calculating the figures that were missing. So we've completed A and we've completed B. Now we're busy with C. And for C, guys, we are looking at the proceeds of sale of fixed assets. So back to the information on tangible assets, which we were busy looking at. Proceeds, immediately we're looking at the sale of fixed assets. Were there a sale of fixed assets during the financial year? Yes, there was, because we've got, according to the information that was given to us, vehicles were sold at carrying value. So I'm going to use this bit of information to work out the carrying value, the sale of the vehicles. At what price was the vehicles sold at? So immediately the question, or the information rather, tells me it was at carrying value. Now, what do we mean by carrying value? This is something that you've learned from grade 10. Carrying value is simply cost minus accumulated depreciation at the date of sale would give me my carrying value, what the asset was actually sold at. So if I read down the cost price of the vehicle, so the cost price of the vehicle was 350,000, and the accumulated depreciation was 247,500. So immediately I've been given the cost price, but more importantly, I'm also given the accumulated depreciation at the date of disposal. So all I've got to do is take these figures, subtract them, and I'm going to get my carrying value. So let's do that. Okay, let's move this across. So the cost, 350,000 minus my accumulated depreciation to give me my carrying value 102,500. So that is my carrying value. So let's just record that in our answer sheet. There we go. So C. Remember, guys, I've done the calculation already, but in an exam situation, you've got to show calculations. But I've done it already, so I'm just going to fill in that amount one more time. There we go. It is 1025, and then 2 zeros. Okay, so that is obviously the carrying value or the proceeds from the sale of the vehicles, which is at carrying value. Okay, right, left now with D and E. So let's go back to that cash flow statement. Okay, not there. Information. And we're looking at information number 8. So the next slide. Okay, so back to that cash flow statement. Okay, so done, completed. We're now looking at D. D wants me to calculate the net change in cash equivalent, or the net change in cash and cash equivalent. In order for me to calculate D, one of the most simplest calculations, guys, all I'm doing is I'm taking the totals that is already given to me from my 3 main sections of the cash flow statement. So cash effects of operating activities, to that, cash effects of investing activities, and then I've got cash effects of financing activities. So the sum of these 3 totals, okay, is going to give me the net change in cash and cash equivalent. So let's get the calculator out. Okay, so we've got at the top 542, 250, and to that, remember I've got this in brackets, which means I need to obviously subtract. I cannot add, so minus 631,750. Okay, and then I've got finally plus, because it's a positive figure, 385,500. Okay, to give me my net change in cash and cash equivalent, an amount of 296,000. Okay, so 296,000. Let's fill that in. 296,000. Okay, simple, guys, not difficult. Right, and then finally the last calculation is the letter E. Let's just extend that page there. And again, not difficult. Okay, cash equivalent at the end of the financial year, that's what we're calculating. So remember, we've already got, let's just quickly fill that in one more time. Okay, we've already got 296,000, and they now want me to calculate my cash equivalent at the end of the year. In other words, how much of money do we have in our bank account at the end of the financial year? So all I'm going to do, guys, is take balance that I've just calculated, my net change in cash and cash equivalent, 296,000. Then I've got my balance at the beginning of the year, which is filled in for me, 198,000, and it is an overdraft because it's in brackets, so I'm obviously now subtracting these 2 figures. So let's do that quickly. So 296,000 minus the balance at the beginning of the year, 198,000, to give me my balance at the end of the year, a positive bank balance of 98,000. So let's fill that in. So I've got 98,000. Okay, right, 15 marks, guys. Not difficult to fill this in. Just make sure that when you are doing this in an exam situation, you show bracket work. So even if you've made silly mistakes, you've forgotten to add a 0, which can happen, at least you get part marks for showing calculations. Okay, right, let's move on now to our next question. Okay, so the next question, they now want us to calculate the following financial indicators on the 31st of December 2011. And the first calculation that they want us to complete is my operating expenses on sales. In other words, the percentage operating expenses on sales. Quite a straightforward calculation, guys. Operating expenses, so I'm going to take my operating expenses, which I will find in my income statement, and I'm going to divide this by sales. It tells you operating expenses on sales. So divided by sales. And remember, they want a percentage, so obviously I'm going to multiply by 100. All right, let's go to my information. And we're going back to our income statement, because that's where I'm going to find operating expenses and sales. So there we go. The very first two items at the top there, guys, I've been given sales, and then there's my operating expenses for the year. Okay, so I'm going to take my operating expenses, 2,475,000. Okay, 2,700,000. Let's just go back there. 2,475,000. Just check one more time, guys. 2,475,000. Okay, correct. And I'm going to divide that by sales, 9,900,000. Okay, so divide that by 9,900,000. Okay, and then times this by 100. So let's get that calculator out. Again, I'm just going to quickly... Okay, it doesn't want to move. Just fix that. Okay. Abram, do you want to just remind the viewers about the competition while I just move this calculator? You know what?
Actually, I got a challenge over the Facebook page that if I want my number to win also, because my number is number 6, remember, Mahesh, I must make a dance. So I'm not going to make that dance. There's a mindsetter that challenged me on that one. But however, I'm going to urge you also, if you've chosen your number, make sure that you go to mindset.co.za/learn/stop the clock. But maybe if you'd like to see me dancing, enter now and let's see if your number wins, I'll dance for you. Maybe if your number is 6, then I'll dance for all the 6. Yeah, Mahesh, let's continue.
Right, guys, so I've got my operating expenses divided by my sales, 9,900,000. One more zero there. That's correct. Okay, and then that obviously gives me times that by 100, and that should be 25%. Okay, so let's fill that in, and that gives me 25%. Okay. Right, so first calculation done, guys. Quite straightforward. Let's move on to the next calculation that they want me to complete. The next ratio that I'm going to now calculate is your solvency ratio. Okay, now remember the word solvency, guys. Can the business pay its entire debt? In other words, total debt, long-term as well as short-term. So my solvency ratio, I'm now comparing total assets is going to be compared to total liabilities. Okay. Right, let's now start with my total assets. Immediately I know these two are balance sheet items. So in my information, I'm going to go straight to my balance sheet. My total assets for 2011, that's the year that they want me to do the calculation, is already given to me. So I don't really have to add any amounts. It's given to me 8,031,000. So let's take that through. Okay, so my total assets, 8,031,000, okay, is going to be compared to my total liabilities. Now remember, total liabilities is your non-current liabilities plus your current liabilities. So back to the balance sheet, guys. Okay, so there I'm looking for non-current liabilities. So there's my non-current liabilities for 2011, which is 600,000. And to that, my current liabilities, trade and other payables, is the only current liability. Okay, so 758,000. So adding these two amounts up is going to give me my total liabilities. So let's take that through. Non-current, firstly, 600,000. Okay. And then I've got my current liability, which is just the trade and other payables. So back to the information, an amount of 758,000. Okay, so plus 758,000. Okay. Right, let's now carry on with the calculation. Let's get the calculator out again. Let's clear this. So I've got 600,000. Okay, and to that, guys, I'm adding 758,000 to give me my total liabilities, 1,358,000. So 1,358,000. Okay, let's just bring this total down, 8031,000. Okay, to complete this ratio, remember, I always divide the right-hand side first. So I divide by 1,358,000. Whatever I do on the right-hand side, I have to do on the left-hand side, so divide by 1,358,000. Okay, and this is going to give me 1. Let's now look at the the left-hand side. So let's just clear that. Okay, so one more time, it was 8,031,000. 8,031,000. Okay, and we're going to divide that by 1,358,000. Lots of zeros, guys, to give us 5,9.
That's why a lot of people make mistakes.
5,9. But talking about mistakes, Abram, I think something that the kids can really appreciate is, as accounting teachers, we always give them a separate question paper and a separate answer book.
Yes.
Okay,
yes,
so
yes.
I'm obviously going from one slide to the other, but they've got their question paper separately and their answer book separately.
So,
okay.
But still, mistakes are still possible either
Exactly,
way.
it is, with those zeros. Right, guys, so the solvency ratio, very solvent, this business is 5,9:1. What does this mean? For every 1 rand of total debt, the business has 5 rand and 90 cents worth of assets. So this business is obviously very solvent. Okay, right, next calculation, guys, is my debt equity ratio. Another, okay, there we go. Right, that should be fine. Debt equity ratio, a very, very famous question in your exams. Let's just quickly change the color. Debt equity ratio, debt, remember, I'm looking at non-current liability, and I'm comparing this to equity. Okay, so that's obviously my formula. Non-current liability is compared to total equity. Right, let's start off with non-current liabilities. We came across this figure already. Remember, our non-current liability for 2011 was 600,000. So let's simply fill that in. 600,000 is my non-current liability. Equity, shareholders' equity, so back to our information. And again, we're going to find this in the balance sheet. So there's my total equity. Ordinary shareholders' equity for 2011 is already calculated for me, guys, 6,673,000. So let's take that through, 6,673,000. Okay, 6 million, sure, I've forgotten already. Let's go back. 6,673,000. Okay. Right, again, let's work out the ratio. So again, guys, I'm going to divide the right-hand side by 6,673,000. In other words, you know this already. The right-hand side must always equal to 1. Whatever I do on the right-hand side, again, doing on the left-hand side, 73,000. So let's get that calculator out again. Okay, so we're taking 600,000 and we're going to divide by 6,673,000. Okay, to give us 0,08, or if we round this off, it's going to be 0,1:1. Okay, so obviously, looking at this ratio, one can conclude that this business is low geared. What do we mean by low geared? Low geared simply means that they do not rely that much on borrowed capital. For every 1 rand of own capital, they've borrowed only 10 cents. Okay, so the borrowed capital is 10 cents compared to 1 rand of own capital. Hence, we use the word low geared. Low geared means low risk as well. Okay. Right, how are we doing on time there?
I think we are about to take a net break, and I'm about to stop my clock now.
Are you?
So mindset is get
and
over.
Is it this time for real?
Yeah, this time it's for real.
Okay.
I mean it. All right, let's just do this. Mahesh, I need you to, you're going to refresh the page for us. As you do that, mindset is, I'm just hoping that it's going to be my number. But nevertheless, the winner will be walking away with an awesome CD by DJ Whiskey called The Rebirth. And also, later on, we'll be announcing a winner of this awesome CD case. So as Mahesh is trying to refresh there, I'm just going to say this shout out to all the mindsetters that are on the page and that are talking to me. Riboni Komane, holla to you, mindsetter. Sabelo Jirain, holla to you. Kevin Lovu, our usual suspect, a mindsetter, holla to you too, mindsetter. And to other mindsetters such as Samgelisiwe Dami Minentle Hadebe, holla to you too for thank you for watching the show. And I must say, Mahesh, this is the part that a lot of mindsetters enjoy so much when it comes to accounting. So yeah, we're about to find out. And can you refresh again? I think it's. Can you refresh again?
Okay, gonna do that one more time.
All right, just for it to be fair. Well, I think it is fair. Yeah. Do you mind telling us, Mahesh? Oh,
okay,
no.
Should I just read out the last number?
Yes.
Okay, the last number, guys, is that 5.
So oh no, that was so close. Just one person liking, and it was going to be my 6. But otherwise, to all the lucky mindsetters that guessed 5, you are going through to our lucky draw, and then I'll be announcing the later just after the break, just before the end of the show. So for now, I'll see you after the break. Welcome back, mindsetters. I'll be announcing just before the end of the show the winner for our competition, but the clock has stopped rather on 5. So we'll be Mahesh will be taking us through to the curio code, but I must give the code to the mindsetters that the code for today's show is AC12. So get over to curio.co.za, and Mahesh is going to be telling you more.
Okay, guys, just moving away from that question that we were busy with, to look at this particular question that was giving some of you a bit of a hassle. It's obviously one of the multiple choice questions. Question 4, that's the one that I'm looking at. So let's read the question first. If the solvency ratio is 1:1, what does this tell us? Okay, now solvency, remember we've just done the solvency ratio for the March 2012 paper, and your solvency ratio obviously is looking at total assets is to total liabilities. So if the ratio is 1:1, this is basically telling us that although this business is solvent, however, there is that risk of insolvency in the future. In other words, 1:1, yes. Is it safe? It's a bit midway. So 1:1, guys, yes, the business is solvent. However, in the future, there is that risk of the business becoming insolvent. In other words, total liabilities becoming higher than total assets. So let's look at the options. Option A, the company is solvent. Option B, the company is insolvent. Definitely not. No risk of insolvency. Definitely not. The risk of insolvency in the future. So guys, those of you that said A, okay, you are correct, but D would be the more correct answer. Okay, the more appropriate answer would be D, risk of insolvency in the future. But remember, A is also correct, guys. The company is solvent. Okay. Right, can we carry on?
Yes, please.
Okay, brilliant. Right, let's now look at the next question. So we're moving on to 1.5. I'm sure we skipped something. Let's look at 1.4 first. Okay, question 1.4, comment. So we've done the calculations now. They want us to comment. Comment on the operating efficiency of the company for the year ended 31st December 2011. Quote 2 financial indicators or actual ratios or percentages relating to the income statement to support your comments. Okay, so operating efficiency, guys, obviously deals with profitability. So that's what we're now looking at. Okay, so immediately, let's now go to our information. And let's go to information number 7, because that's the page where we were given financial indicators. So information number 7, remember, we're commenting on operating efficiency or profitability of the business. So remember, when I was going through the information, I already mentioned that the first 3 ratios, okay, all 3 deal with operating efficiency, all 3 deal with profitability. So if we look at operating expenses on sales, guys, 2011, if you remember earlier on, we calculated this at 25%. Now let's start with operating expenses on sales. Remember, your operating expenses, the lower your operating expenses are, the higher profitability will be. Now, if we examine these ratios, 2010, my operating expenses were sitting at 18%. 2011, it's gone up to 25%. So in other words, there's obviously been an increase in operating expenses. So clearly, an increase in operating expenses simply indicates to one that the company is not controlling its expenses well. What do we mean by this? Let's take, for example, their telephone account. There could be abuse of that telephone. Water and electricity, there could be wastage. Stationery, you could get maybe the secretary that is taking some of the stationery away for personal use, and the business is not aware of this. So the business is clearly not managing its expenses well. So immediately, the first ratio, if I do quote the first ratio, guys, there's not much time for me to actually write this down, so you need to listen to what I'm saying. If I quote the first ratio, my comments would be, there has been an increase in operating expenses. This indicates that the business is not controlling its expenses well enough, and there's obviously wastage as well. Right, the next ratio that we can use, because remember the question wants us to quote 2 ratios, operating profit on sales. So if we look at operating profit, the word profit, obviously profit, the higher the profit is, the better it is for the business. So if we examine these percentages, we've got 2010, previous year, my operating profit as a percentage was sitting at 14%, and then 2011, it's gone down to 11.3%. So clearly an indication that there's been a decline, there's been a decrease in profitability. So again, guys, remember, you are quoting the ratios because the question wants you to do that. You are then mentioning that there's been a decrease in the ratio itself, which indicates there's a decline in profitability. Okay, right, let's move on now, guys, to the next question. Let's see how much of the next question we can complete. Okay, the next question, 1.5, would the shareholders be happy? Would the shareholders be happy with the returns, earnings, and dividends for the year ended 31st December 2011? Explain, and then quote 3 financial indicators or actual ratios or percentages or figures to support your comments, and this is for 12 marks. So guys, clearly with this question, it's a yes or no question. Would the shareholders be happy? Yes. Will they not be happy? Obviously a no. Now remember, we obviously are told to comment on returns, earnings, and then dividends. Let's now go back to our information and let's look for these ratios and comment accordingly. So let's start off with returns. I've got return on average shareholders' equity. So if we look at this return, 2010, the return was sitting at 37%. 2011, the return is sitting at 35.5%. Return means what are you getting out of your investment? So clearly, as a shareholder, would you be happy with this return? Now, some of you may say yes, some of you may say no. Let's look at both options. If I say no, 2010, my return was sitting at 37%. 2011, this return has decreased. There's been a drop in return of 35.5%. So as a shareholder, sorry, I'm not happy with this. There's been a decrease. But then you might get other shareholders that would say, but hang on, although there's a decrease, this is not bad because a return of 35.5% is actually quite good. If you can compare this to alternate investments. So for example, with the banks, as an example, would they give you interest at a rate of 35.5%? Definitely not. So those of you that would say yes, the shareholders would be happy because although there has been a decrease when compared to alternate investment, 35.5% is actually not that bad. Okay, so be aware of that. Let's now look at earnings per share. Earnings per share sitting at 85 cents in 2010, 2011 sitting at 78 cents. So again, some of the shareholders would feel that, sorry, no, I'm not happy because there's been a decrease in EPS, earnings per share. So from 85 cents, it has decreased to 78 cents. So if you say, no, I'm not happy, absolutely correct, as long as you can substantiate. In other words, you tell us that there has been a decrease in EPS from 85 cents to 78 cents. But then again, guys, there could be other students that could say, but hang on, although there has been a decrease, 78 cents is actually quite reasonable as an EPS. Okay, next item that we're looking at is dividends per share. Dividends per share, again, guys, from 60 cents, there's been a decrease to 53 cents. So again, like I've mentioned, you could say, no, I am not happy because there's been a decrease in DPS, but then other students may say, yes, I am happy because although there has been a decrease, 53 cents is quite reasonable. Okay, so when it comes to this question, guys, you need to remember that you can obviously either say yes, okay, or you could say no. But remember, guys, you cannot say both, yes and no. You've got to choose. Yes, I am happy. No, I am not happy. Okay, Abram, I don't know how much time do we have. We've just got one more question to do. Should I just try
I think let's try and do it.
Yeah, let's try it and finish it. Okay. Right, guys, the last question, 1.6. We don't have much time, but let's see how much of this we can complete. The CEO feels that it would be a good idea to increase the loans next year, quote 2 financial indicators to support his opinion. Okay, right. The CEO wants to increase the long-term liability. In other words, he obviously wants to take out further loans in the next financial year. You are told to quote 2 financial indicators to support his opinion. Now, in other words, he's not asking you for advice. He's made up his mind, and you've got to quote financial indicators, in other words, telling him, yes, it is a good idea. So let's look at which financial indicators we're going to be looking at. Okay, so back to the information. Let's start off with, firstly, debt equity ratio. Okay, now remember we did this calculation earlier on, and if I remember correctly, the debt equity ratio was 0.1 is to 1. Okay, so immediately 0.1 is to 1. We know that the business is low geared. Low geared simply means it is low risk, does not rely that much on borrowed capital, and banks would obviously offer the business further loans because they are low risk. So that is the first ratio that you can actually quote and obviously discuss. Let's look at the second ratio that you could use, guys. The second ratio, which also will help you decide on risk, is your return on capital employed. Now, if we look at the return on capital employed, the return is sitting at 47%. And if we compare this to our interest rates, okay, I'm sure the interest rate was given. Let's find that interest rate. The interest rate is in the balance sheet. There it is, down here. The mortgage loan, the interest rate is 14%. So if we compare the 47%, that is the return, to the interest rate, which is at 14%, we can obviously conclude that the return is much higher, significantly higher than that interest rate at 14%, which means it's actually worth borrowing more capital because your return is actually very, very good. So you're borrowing the capital, you're expanding your business, and obviously the return is extremely high. Okay, right, we finished the question.
All right, Mesh, I have a very quick one, advice. There's someone who posted on the page saying that they have a concern and a question that a lot of times accounting students do not finish on time because there are so many questions to answer. What is your advice quickly?
My advice, guys, is practice, practice, practice. The more you practice, the better you get at it, and you're going to see a repetition in the way the questions are asked. So please remember, you've got to practice. That's the only way. You can't sit and learn accounting. You've got to do accounting. Okay, that's my advice.
And for my case, I always worked on the sections that I knew that they had a lot of marks, so start with those ones. And the winner for today's competition is Kyle Knight. Congratulations to you. This awesome CD is coming your way. Mindsetters, thank you for tuning in. We love you.